Ladies and gentlemen, welcome to Grant's Interest Rate Observer of the Air. I am Jim Grant, and with me today, the usual cast of characters, except for one. I'll get around to the one presently. Eric Whitehead at the dials. Phil Grant over there, he can talk, but we won't hear him, so that's not all bad. And then the great Evan Lorenz to Philip's left. And as I mentioned, I'm Jim Grant. And joining us today is Biff Robillard, who is the president and co-founder of Bannerstone Capital Management. That's in Minneapolis, where it's not snowing. Here in New York, it is. We feel a little bit like honorary Minneapolisians. Is that the right word, Biff? Yeah. Biff, it is delightful to have you on the program, which program, incidentally, or not so incidentally, is sponsored by three separate corporate entities. One is Health IQ, the second is Zip Recruiter, and the third is Grant's Interest Rate Observer. Yeah, we just rammed that into the conversation. Biff, welcome to the Grant's Interest Rate Observer podcast.
Well, thank you. I'm delighted to be here.
Yeah. So I know Biff as a thinker. He thinks of himself principally as a father of two and as an angler, fisherman. But I think of him as a thinker, and he is practiced and quite successful in thinking along the lines of a market technician. In fact, he is a chartered market technician, and in fact, was sponsored in that endeavor, that scholastic achievement, by none other than Robert Farrell, who was the kind of the Benjamin Graham of market technicians. So, Biff, without further ado, what are you thinking about?
Well, I'm sorry about the weather. I'm thinking a little bit about New York weather. But in the world of markets, I find myself reflecting on the very high likelihood that we're in a zone of epoch change, of meaning as an epoch. I sense that not a unique perspective, but a strong one, and the most pressing one in my daily life here in Minneapolis is observing signs that may point us in the direction of the new epoch. Are we leaving the Pleistocene and entering the Holocene? I suspect we are, and it's going to be very important for future investment success.
Holocene is a pretty bullish, is it? Holocene?
Well, Holocene was better for people, if I've got my science right. But yeah, I think the setting aside better or worse, I think it's important to think of it simply as different. We can adapt.
Yeah, what kind of differences are you thinking about? We've had, for example, Evan reminds me that back when Ronald Reagan came in, his first term in 1981, he had seemingly nothing, as we can see now in retrospect, nothing but upside. GDP growth was dead in the water. The inflation rate was pushing 12%, jobless rate topping at over 7%, the 10-year Treasury 12.5%. Public debt was a mere 1/4 of GDP, and the S&P 500 traded at 9 times earnings. That was a setup for Ronald Reagan. So in comes Trump, and GDP growth is knocking on the door of 3. The inflation rate's less than 2, or that's the Fed's view. It's 2. All right. Plus, jobless rate, low. 10-year Treasury nowadays is 280 something. It had been 232. So, and the public debt is now knocking on the door of 80% of GDP, and the S&P, let us say, is not at 9 times. So the setup is different, right? We've had a 35-year bull market in bonds, which may or may not have ended. We think it did in July of 2016. Now, how does the halitosis age? What was it you were talking about?
Holocene.
Ah, yes.
Well, I think it's a very apt comparison, perhaps not so much in a predictive way about future GDP and interest rates per se.
Come on,
but at any rate,
we're dealing with the future in this broadcast.
The idea would be that when I arrived, on the street, so to speak, in the early 80s, about the time of the Reagan reign, and it was clearly, in retrospect, an epic change. It was a new era, and it was very beneficial to recognize it relatively early. You may remember Stan Salvigson, fellow who was working with Bob Farrell at Merrill Lynch in those days. Stan was, I think, the first guy I bumped into that was arguing that it was all different now.
Okay, you're keeping us in suspense, though, Biff. How is this going to be different?
I think the investment themes that benefit from secular forces will change, is changing.
All
So
right, but come on, Biff, in what direction, for Pete's
well,
sake? We have to trade
example,
this.
I think the long bull market in bonds has rewarded an entire subset of investments that will now find a headwind with at least rising rates, probably rising inflation. They're probably the same thing in so many ways. So I think the playbook will change a lot. And 5 years from now, 6 years, 8 years from now, the changes may be pretty obvious, but there'll be a lot of water over the dam.
Right, we want to get in on the ground floor of these changes. So how should we be thinking about it, and what should we be doing about it?
Well, in my world, I'm certainly fading the dividend aristocracy play, and because it's important, I think, just to grapple with what the likely effects are of a secular bond market that is fundamentally different. If you go back to the 1950s and 60s, you may have a fossil record there you can examine to get a feel for this.
Biff,
But
you're talking to a fossil. I was actually there. Yeah.
Yeah. Well, I sort of was too.
Okay, but Biff, let me ask, because you're a chartist and a technician. You think about things in a different way than some of our listeners do. The characteristic of the first 10 or 15 years of the bond bear market of 1946 to 1981 was its slow pace. It took 10 full years to wring 100 basis points to the upside out of that bear market. It started at 2.25, and 10 years later, in 1956, it was about at 3.25. So reference to the long-dated Treasury. So does your chart work give you any intimation of the tempo of, I guess we agree there's a bond bear market in progress, do we not? If we do agree, what's the tempo?
Yeah, I think we agree.
Well, what's the tempo? Is it moderato, andante, or prestissimo? What is it?
I don't know that success will depend on an accurate forecast of that. It'll help. I think the thing that Bob Farrell pointed out to us so long ago is there's a remarkable thing in markets. They trend. We can talk about why or how, but they do. They trend. And so if the trend changes, which I suspect it is, that'll be the next question is what's the rate of ascent of this new trend? And it will matter, but the most fundamental thing to be right on is this pivot. Getting right on the pivot is primary, and perhaps being lucky enough to early guess about the subsequent rate of ascent would be helpful, but not essential. And I suspect it's going to be gradual. I'm going to look back at the 50s and 60s, and I suspect it will be a gradual rate. That's purely a guess. The charts will reveal this in time, and good chartists will probably cotton onto this idea sooner than mediocre or bad chartists.
How are you positioning Bannerstone, if I may pry?
Well, we're a little bit like waiting for Godot, honestly. We've been in this mindset for a year or two, and there's some evidence that we may be right, but it's fairly thin soup. The markets are, it's like a confused sea on a boat. Feels like there are many sort of trends fighting it out, which is probably about right. If it is indeed an epic change, I don't expect it to necessarily all happen at once, but we're definitely betting on higher volatility in our vol arb hedge fund. We're profiting nicely from higher realized volatility, to be not to be confused with merely implied volatility, but actual things actually moving around day to day, not the implied volatility. That's happening.
Are you short one and long the other? You got a play on the differential between implied and realized?
Yeah, well, we can be at the moment. A new position for us, which is profitable, has been a pairs trade in energy, in equities, oil stock indexes that are bouncing around a lot and not going in any particular direction very fast, just back and forth. That's very good for us. But we would think that we believe that this is not revolutionary, but we think it's wise to shorten lower duration, shorten maturities, presume that it will never be better than the last 5 years for the dividend aristocrat, to bet on growth. We think it's going to be very, very important in our equity portfolios to perhaps have the ability to raise prices at some point, which is a long forgotten art in American business. But as my dad taught me, it's really good for the bottom line.
Which companies might embody this virtue of being able to raise prices? What companies come to mind that one should own in that regard?
Well, let me click on my screen in front of me and give you a couple ideas of things that are working for us. I think one of the fintech companies seem to be, for example, Square. We're long Square SQ. It surprised even me.
What does Square do for a living?
Well, Square is what we think of as a fintech firm. Of course, Square is best known for its tiny appliance, which can fit into a cell phone and process credit card, debit card transactions on the spot. And they're elbowing their way into various other businesses. And I remind you that I reluctantly speak about fundamentals like what in the world a company does. I'm much more interested.
Can you give us the ticker?
Yeah, the ticker's SQ, and I'm
well
I'm
done. All right. So Evan,
it's up 66% this year.
well, that's okay. That's the ticker.
SQ.
Well, we are brought to you today by Health IQ, which is a life insurance company, the life insurance agency that helps health-conscious people like runners and cyclists, weightlifters, and yes, vegetarians get lower rates on their life insurance. So go to healthiq.com/grant to support this show and see if you qualify. So you get points on various insurance policies for being a good citizen, but you rarely, until now, have gotten points for living a upstanding, wholesome, and healthy and kind of buff life. 56% of Health IQ customers save between 4% and 33% in their life insurance. And those savings are exclusive to Health IQ. Health IQ can save you up to 1/3 because physically active people have a 56% lower risk of heart disease, and 20% lower risk of cancer, a 58% lower risk of diabetes. So to see if you qualify, get your free quote today to healthiq.com/grant or mention promo code GRANT. That's GRANT. We can spell that one when you talk to a Health IQ agent. So thank you, Health IQ.
Biff, a question for you. You studied under Robert Farrell, and he's famous for 10 rules that he laid out on the market. And the second one is excesses in one direction will lead to an opposite excess in the other direction. I guess as you study the market and kind of as you studied under Farrell, what were the excesses in, I guess, the cycle, and what do you expect to reverse in the opposite direction?
Well, I appreciate that question because I think it's got two parts. I think the temporal, the obvious one, the pressing one is when does the next cyclical correction, the relief of cyclical excesses, when does that commence? Maybe it's already commenced. Maybe the Q1, maybe the high's in. But I don't have a great answer for that. I'm always nervous in every third quarter, given my history in the markets. But from a secular standpoint, a more important answer is we are in the process of relieving excesses from negativism. I think there was a profound and important secular low in investor confidence in particularly the equity market in 2008 and 9. And therefore, like the market of the 50s, which I think was a bull market born in the 30s and delayed by the war, the most important force is an upward force, lift, not gravity or drag. And I think that we're likely to see some, spectacular cyclical corrections and at any moment. We seem to be overdue for one. But I think it would be catastrophic for an investor to presume the next cyclical decline, which could get your attention, is the onset of a new sort of secular decline. I think it'll be, as we saw in the 80s and the 90s, saw in the 50s.
That speaks to stocks. How about bonds, Biff?
Well, bonds, Jim, you're my bond guy. I don't know. I'm gonna, until I have a new hypothesis. My hypothesis will remain the gradual onset of a bear market, somewhat like the one you've alluded to in the late 40s and 50s. And it does seem reasonable that these mysterious forces that have constrained global inflation and interest rates still seem to be afoot. I'll know when I see it if I'm dead wrong on that. But I think a reasonable way to proceed is to fade interest rates and to be very alert, but not necessarily to adopt the kind of posture that was so useful in the late 70s and early 80s. That we're way, this may be a very long bear market, and it may have a fairly flat look to it on the charts for quite a while until the exponential math sort of gets to you, and then it looks a lot different. But we could very well be in a fairly flat part. But the lows are in. I think the trend on rates will be higher. And so that's how I see it, which is probably not a very unique perspective.
This portion of the Grant's Interest Rate Observer of the Air is brought to you by ZipRecruiter. Hiring? Well, every business needs great people and a better way to find them. So something better than posting your job online and just praying for the right people to see it. ZipRecruiter knew there was a smarter way, so they built a platform that finds the right job candidates for you. ZipRecruiter learns what you're looking for, identifies people with the right experience, and invites them to apply for your job. And these invitations have revolutionized how you find your next hire. In fact, 80% of employers who post a job on ZipRecruiter get a qualified candidate through this site in just one day. So businesses of all size trust ZipRecruiter for their hiring needs. Right now, our listeners can try ZipRecruiter for free. That's right. Free. Just go to ZipRecruiter.com/Grant. That's ZipRecruiter.com/Grant. ZipRecruiter.com/Grant. Smartest way to hire.
Biff, back to your idea that the stock market's in a secular bull market because of the negativism in '08.
Yeah.
David Swenson of Yale late last year said he had an index of short sellers that had to be discontinued because there weren't enough short sellers. I have trouble finding enough bears to talk to anymore. Do you really think that there's still this overwhelming negativism in the market anymore?
I think on a secular basis, there's a big reserve. Yes, I think on a secular basis, a cyclical basis, Evan, I agree with you. In January, we have individual investors who have separately managed accounts managed by Bannerstone on a discretionary basis, and we were talking around the coffee maker here in the office about the spike in investor interest in the markets, Bitcoin questions, Netflix questions, some of the classical qualitative indications of a peak in investor interest. And that coincided very nicely with the peak in prices. So cyclical, we may have seen the peak already. And I completely agree. However, on a secular basis, it's remarkable how unenthusiastic investors are. I spent a lot of time around a lot of individual investors for a long time in my career, many years ago. And we're not seeing Bannerstone, or the team here doesn't feel we're anywhere close to what we vaguely remember. It's been a long time since investors were truly enthused, sort of on a secular basis. Like you might remember they were enthused about real estate in 2006 or something. There are a substantial number, in my estimation, of ambivalent individual investors who have not really come back to the equity markets in any big way. It's much more like the early 1980s in that regard, or maybe the mid-19 than the late 1990s.
Right. Hey, Biff, thank you for being with us. I mean, it's been a pleasure. I think of you not only when it snows, you're living as you do in Minneapolis, but sometimes when the sun's out. And I think that in your case, the sun is almost perennially out. So thank you, Biff, and I'll look forward to talking with you soon. This episode of the Grant's Interest Rate Observer podcast is brought to you, drum roll, by Grant's Interest Rate Observer, and in particular, the April 10th conference at the Plaza Hotel, at which attendance is mandatory. Got to show up. Why? Well, you talk about volatility, a deep discounted closed-end funds. That'll be Boaz Weinstein's remit, Boaz being the fellow who smoked the London whale way back when. What's wrong with the gold market? What's right with the gold market? John Hathaway will explore. And here's one: why rising interest rates and a $15 minimum wage will upend a decade of financial engineering in the restaurant business. That's John Hamburger. Well, I don't know. This is going to be a pretty fabulous affair. And as I said, you got to be there. So do. See you at the Plaza Hotel on April 10th. Ladies and gentlemen, thank you for being with us today on Grant's Interest Rate Observer of the Air.